Quit the change artist there. Well, I guess I'm recording. So you read the chapter for today, of course? Right? Sure hope so. You did. You realize it's just a continuation of what we've been doing, right? Not a very big deal. Going to talk about allowance for doubtful accounts today, huh? Bad debt expense? You got it? This is going to be, oh, I don't know, on the quiz, maybe 10 points, maybe 10 points. On the test, maybe 15, 16 points. On the final, maybe 15, 16 points for knowing how to do one thing, right? One problem. And that's the way to approach this, right? Learn how to do one thing, then learn how to do another, then learn how to do another, then learn how to do another. This is not an appreciation of accounting class, right? We're not just giving a broad overview, broad stroke, and then you answer a bunch of easy multiple choice questions and go on with your life, right? That class, in my view, is pretty much worthless. I've seen those classes. I didn't thought it before. I thought accounting for non-accountants once, and that's actually what they wanted us to do. That's kind of why they had the class. They could have just given people financial statements. They could have read them and gone on with their life. About all it was. Wouldn't know what you're reading, of course, but that's the problem. Okay? So each one of these chapters we go through, get it down, right? Just get it down. So this time, what we're going to do is we're going to go through sales, cash sales, credit sales. And then we're going to do it, and we could also do deferred sales, unearned revenue, but we'll leave it out for now, right? You could add that in and companies too. They could have all three, right? They could sell things for cash. What's the journal for selling something for cash? Double what? Cash, credit what? Sales, big deal. How about on account? Debit, accounts receivable, credit, sales. This is actually in this chapter. It is, no kidding, right? It's there, right? It's just repeating what we already did, only now a little more in depth, huh? So each chapter is going to be like that. That's nice. It's cumulative learning, okay? So if you didn't get it the first time through, what do you do now? For some of you didn't. If you didn't get it the first time through, what do you do now? Get it, right? You're really wired, okay? And none of you got to get well enough, did you? I didn't see any 90s on the debt. One person in the 80s, pretty good, right? Real close to where you want to be, okay? You want to go forward as a professional, right? I mean as a professional accountant, finance person, marketing person, you name it, right? Manager. Yeah, you gotta know what you're doing, right? So you want to know this stuff, guys. So get yourself to know it. Don't view it as, oh, I'm just going to get this class over and I'm going to get rid of Richardson, which you will. That'll be good for you. But make sure when you get rid of Richardson, oh, come on. Make sure as you get rid of Richardson that you take the knowledge with you, okay? See if that can happen. All right, anyway. So let's just do a little example, okay? And we'll get into what allowance for doubtful accounts is and bad debt expense. Oh, I told you there were three ways. We said we debit account, debit, cash, credit sales, or debit accounts receivable and credit sales. And then later what do you do when you collect the cash? Debit, cash, and credit accounts receivable. Everybody should be keeping up with me. And then there's that unearned revenue route, right? Where they can pay us in advance. Okay, and what would we do? Debit, cash, and credit what? Unearned revenue, and then what?
When you receive it, you debit the unearned revenue.
Well, when you earn it. When you earn the revenue, right? Yeah. Debit, unearned revenue, and credit what? Sales or service revenue, whatever kind of revenue it is. Right, guys? This is how it works. And then you guys know this stuff. You know how to use it. Okay, here's one other possibility. The customer might not pay you. What do we call it if they don't pay us? A bad debt. And we have bad debt expense. Okay? And what we want to do is we want to record the bad debt expense in the same period we do the sales or the service revenue, right? Why? Why do you have bad debt expense? Well, some people are bad people who don't pay you. They intentionally buy from you knowing they're not going to pay you. Or what else could happen?
They might have tried to pay it earlier or like thought about paying it, and then they might not have the money when they actually.
They might not have the money because they went bankrupt, right? They might go bankrupt. They might have an intention of paying it, right? All good faith, but then they go bankrupt and they can't pay you. That'll happen. Other people buy from you knowing they're not going to pay you. They're just stealing from you. Everybody agree with that? They are. When you buy anything where people grant credit to customers, you get to pay for the people who don't pay. You get a little tiny piece of it. So if you have friends, right, that brag about basically stealing things, If they buy stolen property from somebody, right, and get a really good price on it, they'll be there from you anymore. They're stealing from you and everybody else. If you buy a TV set, a 50-inch TV set for $150 off the back of the truck, it either doesn't work and you bought nothing, or it's stolen and you're part of the sale, the theft, right? Right? You are. You stole it from everybody else that pays full price, a couple $1,000 for that TV set, right? Everybody got it? So, there are thieves out there. That's true. That's why I like to call it bad debt expenses instead of uncollectible accounts expenses. They're bad people. You could also call it allowance for bad debts, or you can call it allowance for doubtful accounts. Make sense? Usually people call it bad debt expense companies. Bad debt expense and allowance for doubtful accounts. I don't know why those will be. Okay? All right? Now, why do we want to record them in the same accounting period? Why do we want the bad debt expense in the same period as the sales? That's why we use this allowance method. In the chapter, they talk about the revenue write-off method, which should be debit bad debt expense and credit accounts receivable. When I give up on the receivable, I debit bad debt expense and credit accounts receivable. That's not allowed under generally accepted accounting principles. But you could use it if the effect is immaterial. What do we mean by immaterial? Material versus immaterial. Something's material if it would make a difference to a decision maker. So you're thinking about investing in the company. This dollar amount in this transaction is big enough that it would influence your decision. So a reasonable person using the financial statements, right? To invest in the company, to loan to the company, go to work for the company, buy things for the company, sell things for the company, got the idea? Do business with them in any way. A reasonable person using the financial statements would be influenced by that, and it's material. If not, it's immaterial, and who cares how you account for it? But why? You were going to say something. I'm sorry. I kept on going. Why would we want the bad debt expense recorded in the same period as the sale? Why do we have bad debt expense? Not just to balance, it's to match things up. Revenues and expenses I want matched up. When do I want to record the revenue? When I earn it, right? In the period I earned it. That's why we're doing all this deferral and accrual stuff, right, guys? It's not when I got the cash. It's when I earned it. I want the revenue recorded. We know when all the expenses associated with getting those revenues recorded. In the same period. So my revenues less my expenses is my best estimate, right, of my net income. Everybody agree with that? That's what I want to do. That's all we're doing here. Well, why do you have bad debt expense? Because you granted credit. If you don't grant credit, do you have bad debt expense? No. You always require cash, they always paid you. You can still have bad checks, I guess, right? But, you don't have bad debt expense, do you? So why do we have bad debt expense? Because we grant credit. Why do you grant credit? You guys are competitors in business. Your stores are right next to each other. You grant credit to people you don't. What could happen? Credit card? Well, no, it's just accounts receivable. Could be a credit card, but it could just be on an open account receivable, right? You let your customers pay you later. He makes his customers pay him right now, today. What's going to happen with some customers? They don't have the cash today, but they'll have it later. So what are they going to do to you? Seeing as you require cash now, they're not going to buy from you. Where are they going to go? Right next door, where his business is. They're going to buy from him, and then he gets paid later, right? Although some of them don't pay him later, that's the bad debt part, right? So you take no risk of bad debts, but you get less sales, don't you? Oh, if I'm willing to take the risk of bad debts, I have more what? Sales. So therefore, I have more revenues. So what's one of the expenses of getting those revenues? Bad debt expense. It just is. Major companies, big companies, or any company, can estimate how much their bad debt expense is going to be. Some percent of sales I'm never going to see. Or the other way I could do it is some percent of my receivables I'm never going to see, right? The sales I'm never going to see is called what? Bad debt expense. I put it on the income statement with the sales revenue. Make sense? What do we call the accounts receivable I'm never going to see? What's that? Allowance for doubtful accounts. You guys read this chapter, didn't you? Not everybody. Hell, I ain't looking at it. You really want to read these chapters before I talk about it. They're going to get tougher and tougher and tougher. And I'm going to be going faster and faster and faster to get through this stuff. You thought I was moving fast already, huh? We were going at a snail's pace. We're going to get going now. But if you don't read, and we're only adding a little bit to each chapter, huh? Which you already know. So what's going to happen here? And if you didn't know it for the test, what's going to happen as we go through? I just talked about this in snowball on you, that's true. But that is true. But what's the deal? If you didn't know how to handle sales, did I just talk about how to do it again? Cash receipts, did I just talk about it again? Yeah, real quick, I did. Don't shake your head, I just told you again. Stuff I told you earlier, right? Exactly the same thing. I'm going to repeat everything we already did, again and again and again, and then add a little bit, and add a little bit, and add a little bit. Are you going to get the new stuff if you haven't read the chapter? No. Right? And you got to pick up what you didn't learn on the first 4 chapters as we go through now, right? Anything you didn't get, you got to pick it up, okay? And you're going to know what you're doing when you leave here, okay? When you leave this class. You're going to know something about financial accounting. That's what we want, okay? And that's what you want too, believe it or not. Okay, so let's do an example. I want to get the bad debts recorded in the same period that I have the sale, okay? That's the key thing here. So let's start a company. Let's start with no balance in any account, right? When you start a company. So we're starting the first year of the company. All right? What's the balance in accounts receivable? Nothing. What's the balance in allowance for doubtful accounts? This is a new account. What kind of account is it? Somebody who did read the chapter. What is this thing? It's the portion of the receivables I expect never to collect. It's kind of like accumulated depreciation on equipment or accumulated depreciation on building. It's a contract. It's a contra asset. Okay. How many of you did read this chapter? Okay. This is the class with a bunch of freshmen in it, right? How many of you are freshmen? Okay. The other class has almost no freshmen in it. It's all sophomores and juniors. You know what they all did? Almost all of them read this chapter. They did a little better on the test than you guys did too. Uh-oh. What have they learned? Survival techniques. Read the book. Do the homework. Show up for class. You guys got that part right? Right? It's not enough though, is it? You don't know what I'm talking about when I'm talking about it. You guys don't have a clue what I'm talking about when I said allowance for doubtful accounts. Should have been just, oh yeah, that's a contrast. I read about it. I know what it is. It works just like accumulated depreciation. It's the portion of the accounts receivable I'm never going to collect. That's what it is. Big deal. Okay? So what's net realizable accounts receivable going to be? It's my accounts receivable, that's my allowance. Could have read about that. What does realizable mean? Realizable. Told you guys. Recognize as you record it, revenue, expense, even asset, liability, equity. You made a journal entry. You recognize in the financial statements, in the statements. What does realize mean? I realize it. I get paid the cash. It's realized. How many of you do that? I just said that. I've said that at least 5 or 6 times. So when you guys go to work and your boss tells you something 5 or 6 times, you're not going to have a clue what they're talking about on the 6th time. You won't be working there anymore. I know a bunch of you are 18, you're 19, some few people might be 20, right? You're young. It's really competitive out there. It's not cutthroat competition. Some people know what they're doing, some don't. The ones who know what they're doing, we keep. The ones who don't, we suggest they go work somewhere else. We don't ever fire anybody. We counsel them out, right? It's probably not the right place for you. Don't be that person. Come on, you guys. Are your other classes starting to fire up a little bit? Gee, I'm sorry. I hope they are. Either that or you're going to have a miserable end of the semester. If your other classes aren't having you do anything yet, they will. Trust me, it's going to happen, right? They're going to deliver for you. Okay, anyway. Those go on which financial statement? Balance sheet or income statement? Balance sheet, of course. What's net realizable accounts receivable on the balance sheet? It's accounts receivable less whatever's in the allowance. That's how much you think you're going to get paid. Accounts receivable is what people owe you. Allowance is what? What you think they're not going to pay you. What's the difference between the two? Probably the amount that you think you're going to get paid. You know what they owe you? Less what your estimate is of what you're never going to see is probably what you think you're going to collect. Net realizable. What's the difference between realized and realizable, you folks? Realized is I got the cash. What's realizable? I'm going to get the cash, right? Realizable. Okay? English skills. Okay? That's it. All right? Big deal. What's on the income statement? Sales. Let's do service revenue, though, because I don't want cost of goods sold yet. We'll do that in the next chapter. Okay? So we got service revenue. And what else is going to go? That's what financial statements revenue on. Income statement. Beginning balance, 0, of course. Always 0 there, right? Balance sheet you do not close. Everybody knows that. Permanent real accounts. Income statement accounts you close, don't you? Everybody knows that too. Okay? Let yourself use what you know. Stop doing brain dumps after a quiz or a test. We're going to have a final where I expect you to know this stuff inside and out, right? And then in 102, we're going to expect you to know it. If you're in 211, I'm going to expect to pick up where we left off in this class. Everybody got it? If you're a finance or accounting major, you're taking that. And I'm going to make a lot of fun of you if you don't know how to do it, and I'm also going to blow right on by you. The average on the the second intermediate quiz on one chapter, chapter 3, which is principles of accounting in one chapter. It's all deferrals and accruals and stuff with a few things added. The average is 11 out of 25. Guess what grade that is? What percent is that?
44.
44%. What's that? D minus? D? It's a D, is it? I use the same grading scale like I said here. C minus? Yeah, D. And they all think they're going to be CPAs. No, they're not. No, they're not. Probably not. Unless they take a class twice. For what? They get to work, right? Get to work. Want to be successful? She does, I can tell. Right? He does, two people sitting up here in front, they want to be successful. Right? Success isn't just about making money. It's about having a job that's fun. You do stuff, right? Whatever feels good. Okay, what's going to go in the income statement relating to this stuff? Besides service revenue. Expenses named. There's going to be bad debt expense. Absolutely. Okay, and it'll start with nothing too. Okay, so here we go. Let's do some stuff. Okay, let's start our business. Okay, let's say that I sell $200,000 worth of stuff and services, whatever my services are. Okay, I sell $200,000, and 10% is for cash. Therefore, 90% is on account. Okay, we won't do any unearned revenue. What'll that be? Debit what and credit what? 200,000. Debit cash, debit accounts receivable, and credit what? Service revenue. Everybody knows how to do this already, don't you? What did I say? 200,000. This is 200,000. Everybody agree with that? How much do you debit cash for? 20,000 if it's 10%. What do you debit accounts receivable for? 180. Everybody got it? Okay. Then let's say that I collect of that account receivable, I collect 140,000. Debit what? This isn't new.
Service revenue.
What? You have less service revenue because your customer paid you? No. What'd you get from your customer? Cash. Debit cash. What don't you have anymore because they paid you 140,000? Accounts receivable. Got it? Okay. You guys know? Do you know how to do this before we started today? Maybe. That was a joke, right? Everybody knew how to do this. Okay. Anyway, so accounts receivable. What do we debit it for? 180. Everybody see that? What do we credit service revenue for? 200. Okay. Then what happened? And I don't care about the cash for our purposes here. I'm just worried about these four accounts. Okay. Then what happened?
You credited the accounts receivable for 140,000.
Yeah. So what do I have in accounts receivable right now?
40,000.
40,000. Okay. If I were to do a balance sheet right now, what would I have in accounts receivable? 140. Which, by the way, is what all my customers owe me. You add up what every single customer owes you, you get the 40,000. Does that make sense? It is. All the open invoices, when you do read the chapter, all the open invoices, an invoice is what? For those of you who did read the chapter, I apologize for suggesting you didn't. Of course, some did. Okay? What's an open invoice? Open sales invoice. I sold somebody something, I've got a document, probably computerized nowadays, right? It's still a document, right? Okay, what's the deal? It's evidence I sold them something, what I sold them, how much they owe me on that one invoice. You add up all the invoices for a customer, it's what the customer owes you. You add up all the customers, which is all the invoices, and it's what? It's your accounts receivable. That's it. That's what the still haven't paid. Those are the open ones. If you added up all the invoices for the period, that's your sales revenue. Right? Including the ones that are paid. Okay, anyway. All right. So now it's the end of the year, and I want to do financial statements. If I showed 40 of accounts receivable and 0 of allowance for doubtful accounts, what's wrong with that? Some of those people aren't going to pay me. I need to make an estimate of what I'm going to not get paid. And the allowance is going to be that estimate. Everybody hear that? The allowance, and this is the biggest mistake people make on this major problem I'm going to have you do over and over. Okay? The estimate of what I'm not going to get paid is the allowance, of course. It's the contra account that goes with the receivables. Accounts receivable less the allowance is what I think I'm going to collect, okay? Net realizable accounts receivable. On the balance sheet, I'm going to show accounts receivable less the allowance for doubtful accounts. And that's going to give me net realizable accounts receivable, what I'm going to get paid. That's on my balance sheet, okay? That's what I'm doing. So right now I've got $40,000 in accounts receivable. What I want to know is, well, what would the allowance be? What should it be? I'm going to estimate it. Got the idea? Okay, what am I going to show on the income statement? I'm going to show service revenue here, of course. But what else do I need? If I show all this service revenue, it's $200,000, including both the cash sales and the credit sales. Everybody agree with that? Both together, of course. Sales, service revenue. Okay, what account is going to be on there relating to possible bad debts on the income statement? Bad debt expense. It's going to be my estimate of what? This is going to be my estimate of the sales I'm never going to get. The revenue I'm never going to get, the service revenue, huh? So that's what that one is. So if I ask you, I'm going to ask you two different ways to make estimates here. I'm going to ask you to make an estimate based as a percent of accounts receivable. Or when you read the chapter, you can age the accounts receivable, which means what portion of the current ones, right, that are still current, not past the terms, right? So of course they haven't paid those yet, they're not due yet, okay? The ones that are current, what portion of those am I never going to receive? Probably get most of those. Then the ones that are 30 to 60 days past due, a bigger percentage of those won't pay. How about over 60 days? A whole bunch more. How about over 90? Probably won't collect any of them, or very few of them. Got the idea? So I could estimate that way. That would still be estimating how much of the receivables I'm never going to collect. What am I estimating then? Which account? The receivables I'm never going to collect is reflected in which account? Not bad debt expense. That's the sales I'm never going to get. Sales and bad debt expense go on the income statement together. Ah, so the percent of the sales I'm never going to get will be what? No, the percent of the sales of the revenue I'm never going to get is what? That's the bad debt expense. They go on the income statement. Okay. Bad debt. Start reading these chapters, okay? You guys are slowing us down, aren't you? Aren't you? If you'd have read this, you'd already have an idea. And now I'd be talking about it and be crystal clear. What's happening instead? We're spinning our wheels here. You sat in the other class, didn't you? It was different, wasn't it? It's a lot different. What's wrong with him? He's sitting in two classes. He wants to be a CPA someday. If you willing to pay the price. It's a horrible price. You have to listen to me. I think it's horrible too. Right? It's not smarter than you guys. Right? Right? Work. By the way, if you have to come to two classes, of course not. You don't watch videos. You don't have to come to class ever. If you can do what? Learn how to do it and nail those exams. Got it? I don't care how you get to the point where you know how to do it. Don't care in the least. Just know how to do it. How far did you get by not reading the chapter towards knowing how to do this stuff? Not at all. People who read the chapter are light years ahead of you. What's going to happen when we take the quiz? Actually, it's good. Your business, guys. Do it or not. I've had as low a GPA as a 1.4 since I've been teaching this class. 1.4. The first semester of my life. It's just horrible. Every day I hate going to class. Not just the students, me too. Most of them weren't there anyway. They just took their D's and F's. It's crazy. I've had as high as a 3.1. That's a summer scholarship class. It's almost all scholarship kids. They were all 18 years old. They were just motivated. Okay. I can't remember what it was this summer, 2.7, 2.8, something like that. About half of them were scholarship kids, half were juniors and seniors who took the class before and really wanted to get it. And they really went out. Every day they'd always read it. And we just went through and answered questions, got stuff done. Wow, really works well. What if you had a few questions about this chapter? That's all you needed to know. If you You ask me those couple questions. What if you haven't read the chapter? I don't even know what I'm talking about. Oh well. Okay, shoot yourselves. Anyway, bring everybody else down with you. It's kind of true though. Anyway, so here we go. Let's say that we want to figure out what bad debt expense, which we do, should be on our income statement. What's that going to be? It's the portion of the sales you expect never to collect, right? It's an estimate. We also want to put the allowance on here, don't we? What's the allowance? It's the portion of the receivables you expect never to collect. That's what they are, okay? How does equipment and accumulated depreciation work? Equipment is what you paid for it. Accumulated depreciation is the portion you used up, right? It's utility value. And the difference is what's left. So it's the remaining book value. What's the deal here? The receivables is what people owe you. The allowance is the portion you expect never to see. And the net realizable receivable is what you expect to collect, right? Sales revenue, what's that? Or service revenue is what you sold this period. What's bad debt expense? The portion of those sales you expect never to collect. Why do you want to record them in the same period? Because I want to tell people the truth. I want to give them the best estimate I can of what my net income is. So the sales are recorded when? We already know this, right? When you deliver the goods or services. What if they pay you cash? You debit cash and credit sales. What if they're going to pay you later? You debit accounts receivable and credit sales, right? To get the sales in the right period. What if they pay you in advance? What do? Debit cash, credit unearned revenue, right? Why? Because you haven't earned it yet. It's a liability. You owe them the goods, their services, don't you? Then what do you do when you earn it? Debit unearned revenue and credit sales. About half of you didn't understand what I just talked about. You're in big trouble. Big trouble. That has to be automatic, automatic, automatic. Because the assumption now is you know it because we just spent a third of a semester about, at least a quarter, right? Learning just that. You gotta have it. So work on it until you do, okay? And we're gonna keep doing it, right? We're doing it over and over and over. It's okay. Let yourself learn. You can do it. I know you can get it. You're all smart people. I don't even have any brain cells left, and I can do it, right? Okay. Anyway, a variety of sources now, old age being one of them. All right, so now what? Let's be at the end of the year here, and let's set up our first allowance. How would we set up the allowance, you think? I want to have a balance in the allowance account. I bet I credit it. And at the same time, what am I going to record? My bad debt expense. So here you go. Here's a provision for bad debts. We are going to make an estimate of what we should debit bad debt expense for. And we are going to make an estimate of what we should credit allowance for doubtful accounts for. The problem we have is it's got to be the same estimate because debits have to equal credits, okay? It's got to be the same estimate. There are two basic ways we do this. One is, so this is part A, and this is part B, okay? Two different ways you might do this, okay, for the provision. A will take a percent of accounts receivable. Let's say that we think we're never going to see 6% of accounts receivable, okay? That's one alternative. Or, this is an or type thing, right? It'll be one way or the other. This is the type of problem I'm going to give you, okay? 6% of accounts receivable, and by the way, there's one on the practice quiz, there's one on the practice test, got the idea, okay? And the other way could be, what did I say, 6%? Let's say it's 1% of revenue, you got it, of service revenue. Excellent. So you tell me, what am I estimating if I use 6% of accounts receivable? Which account? Bad debt expense or allowance for doubtful accounts? Which one am I estimating? Allowance, because the percent of the receivables I'm never going to collect is the allowance. Okay? What if I use 1% of service revenue? Or 1% of sales, if it's sales? What's it going to be? Bad debt expense. They go on the income statement together. Bad debt expense is the portion of the sales you expect never to get. This is going to be easy if you get that down. This is what's going to hang you up. You'll switch those two. Okay? Or on yourself. All right? In either case, it's going to be debit bad debt expense and credit allowance for doubtful accounts. Please don't mess around with different things. People get real creative here. I don't know why. I'm just figuring how big I want bad debt expense to be, and I'm figuring how big I want the allowance to be. That's it. So it's always debit bad debt expense and credit allowance, okay? All right? So let's do 6% of accounts receivable. If we were using that approach, what would my adjusting journal entry be? These are adjusting journal entries, by the way, right? Whoops. These are adjusting journal entries. That's one, or we do this one, right? Depending on which method we use in the company, right? Different ways you could do this. So this is going to be an adjusting journal entry. These up here were source journal entries, weren't they, everybody? Those are source entries, aren't they? Right? We're just recording transactions, received cash, sold on account, right? Sold for cash, sold on account, and then collected receivable. Yeah, okay? So these are adjusting journal entries at the end of the year, at the end of the accounting period at least. All right, what's 6% of accounts receivable? 40,000 times 6%. What is that number?
2,400.
2,400. What account would I like to be 2,400? Allowance. Got it. I want this account to be 2,400. Right now it's nothing. What am I going to put in there? 2,400. Ta-da. Got it? So I'm going to credit the allowance for 2,400, and what am I forced to do now? Debit bad debt expense for 2,400. You have no choice. Got it? So what would I show an allowance for doubtful accounts? 2,400. What's the difference between the 40,000 that people owe me and the 2,400 I expect never to collect? What do we got? 37,600. What's that? That's how much I think they're going to pay me. It's on my balance sheet. Net realizable accounts receivable. That's what it is. Really good to know what that is. If you're a finance or accounting person, or a marketing person, a management person, human resources person, critical that you know this. Okay? Run your own business, critical. Okay? I could care less how much people owe me. I care how much they're going to pay me. If you owed me $100,000 and you were only going to pay me $1,000, I think it was 1,000. Well, not 100,000 for me. So this is important, right? This is useful. Okay. All right. So what's bad debt expense going to be in this case? 2,400 also. Okay. And it was just forced to be that, isn't it? Got the idea? It was just forced to be that. All right. What if we use the other method, 1% of service revenue? But typically what we'll do is it'll be the credit service revenue, because we know we collected the cash ones, right? So it's 1% of what? Not 200, because that's all the sales. That's all the service revenue. How much was on account? So credit, the credit, right? Credit sales were only 180, aren't they? So it'd be 1% times 180,000. What's that? 1,800? What would your journal entry be? Debit bad debt expense, 1,800. Credit allowance? 1,800. Everybody got it? That's it. Big deal. Only now what would we have? I guess we'd have 40,000. If we use this approach, we'd have 40,000 accounts receivable less what? What would you now have if you think about, well, I didn't write the 2,400 in there, I apologize. Okay, 2,400. Okay, what happens? That changes your allowance to what? 1,800? Everybody agree to that? It changes your bad debt expense to 1,800, huh? Everybody see it? So yeah, 1,800. Well, now how much do you think you're going to collect, I guess? 38.2, is it? 40 less 1,800. And what would we have over here? We'd still have 200,000, of course, in service revenue, and your bad debt expense would be 1,800. Here's the problem we've got. Which one of these are right? I don't know. We're estimating. When you look at financial statements, it's an estimate of what you think happened, and it's going to happen. Got it? They're estimated. Do you really feel comfortable investing your money, lending money, going to work for somebody, selling things to people, buying things from people, where you know the financial statements are just estimates? The answer is yes, because what's your alternative to having estimated financial information? Having none. What would you rather have? The best estimate or nothing? I'll take the best estimate. I don't have a crystal ball. I don't know who's going to pay me and who's not. It gets worse. Think about General Motors and Ford and every other auto manufacturer. They now give 100,000-mile warranties. The year that you make the sale for all the cars, you debit warranty expense for all the warranty repairs that are going to be done in the next 100,000 miles or 5 years, whatever they are, right? And you credit warranty liability. for a huge number. Does this affect their profitability? Well, yeah. Can you make yourself more profitable by debiting warranty expense by a smaller number?
That, but they also might get more sales because people know.
You get more sales because of the warranty. You got it. Very good. And so why do you want the warranty expense recorded in the same period that you sell the car? That's where you got the revenue, right? Just like bad debt expense. So could you make your income more by having less warranty expense? Just estimate it lower? Yeah. Good. Can you make your net income more by just estimating bad debt expense lower? Yeah. Are people tempted to do this? Yes. Because it makes them look better, and the stock sells for a higher price, and they have lower interest rates, and they borrow money. What's the risk of doing it, though? What if you give somebody your money, invest in their company or loan it to them, and then they lie to you about what happened?
You could lose some, you can get fined, go to jail.
Well, even worse than that, you could get fined or go to jail, but usually not. Your business might go bankrupt because what will happen? All the shareholders take their money back. They all sell their stock, and you're done, right? And nobody will loan you money anymore because you lie, right? If I gave, if you gave me $100,000 of your money and I lied to you about what happened with it, what do you want? Money. And the stock market works exactly like that. So we always encourage your bosses, and when you're the boss, tell the truth, the extension of what the truth is. But you're estimating the truth. Might you be biased? Yeah, you got to be careful of that too, right? You want to tell the truth, the extent you know it. Yes.
Now, say a company estimates a bad debt expense of $2,000, but at the end of the year, the bad debt expense is only like $800. Where would you credit or debit the?
Well, what do we do now? That takes us right on to the next thing. Very good. What do we do now? Let's say that we had used this approach and we got the 1,800 in here. What happens when you start a new year? What would you do? You'll close the books. Close the books, right, guys? So when you close the books, what would happen? Let's say we used method B down here, right? So we got 1,800 in bad debt expense. We have 200 in service revenue. What will happen to both of those when you the first day of the new year, first millisecond, right? You close this one, $200,000. It goes to zero, doesn't it? Everybody agree? And then what happens here? Yeah, that's a great question. Okay, goes to zero, doesn't it? They're both zero, aren't they? Okay, so when we start the next year, zero in service revenue, zero in bad debt expense. Every expense is zero, every revenue account is zero. Start a year, right? You guys know that. Close the books. What happens to accounts receivable when you start a new year? Nothing. True? It'll still be 40, won't it, when you start the new year? What will happen to the allowance because you start a new year? Nothing. It'll be whatever's in there, either 1,800 or 2,400 in our two examples, huh? Everybody agree with that? So let's try that, okay? Remember what those numbers were for me, okay? So we had accounts receivable. What was it, 40? We had allowance. With method A, we had, what was it, 2,400 in here? First one. If you did the other method, so these are just separating the methods here. With B, what was the allowance? 1,800. That contra account representing the portion of the 40 you're never going to collect. Two different estimates, huh? Okay? What's going to be in sales in both cases? Starting a new year, nothing. What's going to be in bad debt expense in both cases? Nothing. Because you're starting a new year. Okay? Good. Don't slow down on me, you guys, like you did over the weekend. And on yourself. Okay? So now we start a new year. And let's say that at the beginning of the year we realize that, I don't know, $2,000 of the receivables I'm going to give up on. So what this is our first write-off of an account receivable. This is writing off an accounts receivable. Okay, read this chapter carefully tonight, right, tomorrow. Okay? I'm going to give up on, what did I say? 2,000 of it. So what don't I need anymore if I'm giving up on collecting 2,000? I'm going to give it to a bill collector, right? I'm giving up on 2,000. What don't I have anymore? I think so. I think I'm going to credit accounts receivable for 2,000 because I'm giving up on it. Don't you think that's true? So I'll take 2,000 out of there. Everybody agree with that? So now they only owe me 38,000, right? Everybody agree? But what else do I need to get rid of? What do I want to debit? You got to debit something. What do you want to debit, you guys? Look, I estimated that 2,400 would never be collected, and I just found 2,000 of it. What do? Reduce the allowance by the 2,000. So I found 2,000 of the 2,400. You got the idea? So what's left in there? 400, which is how much of the remaining 38,000 that's owed to me, right? I think I'm never going to collect. You got it? That's it, okay? What would happen, though, if I used method B here and I only have 1,800 in the allowance? I'd still have debit or credit accounts receivable for 2,000, but now it'd be debit the allowance for 2,000 down here, and where am I adding the allowance in this case? I have a 200 debit. Oh, your question was, what if you don't put enough in the allowance? What happens? It'll run into the next year as a bad debt expense, because you screwed up your estimate, right? That's it. So I'll have to have more bad debt expense the next year here than I would here. That makes sense?
So you're just overestimating that years of bad debt expense?
Yeah. A change in an estimate, you always roll it forward to the future years.
Okay.
A correction of an error, I'd go back and restate the prior year. We'll learn about that later, okay? All right? Prior period adjustment, we call it. We go back and restate the retained earnings from the prior year. That would be for an error. This is just change in estimate, right? Made the best estimate we could. What's the odds of your estimate being exactly right? Pretty slim, right? You're picking a number, right? Okay? All right, so now let's do this year. Let's have sales, okay? So let's say that I sell, what was it last time I sold? 200,000, was it? Let's sell 300,000. And 20% is for cash. Sell 300,000. 20% cash. Credit service revenue for 300, would you agree with that? Debit what?
Cash 60,000.
Cash is 60. Accounts receivable?
24.
240. Yeah. So my account receivable would go up by 240. It's 38 plus 240 now. You guys good? Okay. Yeah. All right. And then, let's say I collect out of that accounts receivable, I collect 210 of it. What's that going to be? Debit cash 210. Credit accounts receivable 210. Okay, so here's where we're at. My sales, should have put that in there, for 300,000, right? Okay. I collect 210 cash, reduce the receivable by 210. How much do I now have in accounts receivable, everybody? 38 plus 30. Is that right? I added 240, took out 210. Right? Debit 240, credit 210. So it was 38. Now how much is it? 68? So my accounts receivable on my balance sheet are going to be 68,000. Got it? Okay. So now what do I want to do?
I have to figure out the allowance.
Yeah, figure out the bad debt expense for this year. You got it. What was the first one? How were we going to do it? We were going to do
Percentage of the accounts.
percentage of the accounts receivable, and what percent did I use? 6% of accounts receivable. So let's see what that would look like. Okay, 6% of accounts receivable. Don't know what that's for. Okay, what was this one? 1% of credit sales, right? On account. Okay, what would my journal entry be? Let's do the two journal entries. What would it be for A? Debit what? Yes, it's always debit bad debt expense to do the provision for bad debts. And credit? Allowance for doubtful accounts. What would it be if it's 1% of credit sales? Debit what? Bad debt expense. This is too easy to believe, isn't it? If you understand it, it's nothing. Credit what? Allowance for doubtful accounts. It's just how much, okay? What will it be if I'm doing 6% of accounts receivable? What's accounts receivable, everybody? 68,000. What's it going to be? 68,000 times 6% is $480. $4,080. What do I want it to be? $4,080. Which account? The allowance. If I'm basing it on accounts receivable, I am estimating the ending balance in the allowance, right? You want it to be 4,080. Is that right? Okay. Well, then what are you going to have to credit it for if there's 400 in there now? There's 400 in there now. It's an adjusting journal entry. You're going to bring it up to 4,080. 3,680?
Yep.
Absolutely. Credit the allowance, 3,680, and debit bad debt expense for how much? 3,680. What'll go on my income statement? Sales of 300 and bad debt expense of 3,680. What'll go on my balance sheet? Receivables of 68,000 and allowance for doubtful accounts of 4,080, right? I can put 3,680 in here. Just that, right? Okay? So what's my net realizable account receivable? It's about 64,000, right? Everybody see it? 63,920 exactly. 68,000 less 4,080. Everybody good? Nothing to this. What would it be if you're using 1% of credit sales? What are credit sales, everybody, this year? Not 300. 240, right? Just the credit sales. So 240 times what? 1%. What's that? 2,400. 1%. Move it over 2 decimal places. Okay? 2,400, isn't it? So what would I have for bad debt expense? 2,400. What would I have in the allowance? I put 2,400 in here, don't I? And what's the balance going to be? 2,200. Now let's do a little recap real quick on this. Okay? No, I'm out of time. For these two different methods, let's put down what we would have on the balance sheet in the income statement. Accounts receivable less the allowance is the net realizable account receivable, right? Okay, what's that going to be with our two different methods? What's it going to be for my two different methods? What is the account receivable in both cases? 48,000 it was, right? 48,000. You guys agree with me? What's my allowance here? 4,080. What's that? 43,920, I said? What is it here? 2,400? Oh, it was 68, I apologize. 68. Thank you. What a memory. 63,920? And what's this one going to be? 65.4 or 65.6? Is that what that is? Okay, which number's right for how much my customers are going to pay me? I don't know. It's an estimate. You can take an average between the two if you want, right? Between 4,080 and 2,400 if you want. You're estimating the future, guys. You're guessing the future, taking out your crystal ball. Got the idea? This is where accounting stops and starts and bookkeeping stops, right? You got to make some judgment calls. What are we going to have for bad debt expense in each case? 3,680 or 2,400? Which one's right? I don't know. In both cases, sales are the same, right? Okay, go away and start working.